Hey, it's OG John AG here. Before we get into what just went down in Shanghai, you can find me at OG John AG on X, same handle as YouTube. That's where I post real-time calls. It's not for everybody, just the ones who actually want to know things early. Okay, now let's talk about what China woke up to. Shanghai silver futures opened at $99. That's the number. Western spot price going into that open was sitting at $88.50. Remember the physical demand signal from Shenzhen recyclers we talked about in the last video? Bids running $5 or more above the SHFE pre-holiday close. That wasn't just random noise, it was the market straight up telling you exactly where physical demand was priced before the exchange even switched back on. Shanghai opened at 99, pushed all the way up to $102 per ounce, and then closed the session at 96. One little detail about that session close though, the average price was 96, but the final physical lot reportedly cleared at 102. Whether the average or that final transaction better shows us what true demand actually looks like, that's a fair debate to have. But here's the thing, both numbers are still above Western spot price. That's the part that actually matters. That is a $10 premium compared to where Western spot is trading right now at $86. 10 whole dollars. And Western volume during the Shanghai session was almost completely stalled out. Low volume, heavy premium, physical bids running way above the paper price. That disconnect is not some accident, it's structural. It's baked into the system. Now for the short-term price watchers out there, this is strictly educational, not a signal, not advice. This is just about learning how to read price structure in real time. In the last few videos we mapped out one resistance zone, from 8,720 up to 89. The price has now rejected that zone 3 times. Still no big violent hourly candle body close above it. Price is currently sitting at 8,640 on Western spot. That's back below the zone. 3 rejections from the same level. No decisive breakthrough. That's how you read the tape, folks. The zone is doing its job until something proves otherwise. Watch for a strong, forceful hourly candle body close above 89. Not a wick poking above it. A body. If you're getting value from this, the tape, the data, the bigger picture, drop 3 words in the comments. OG John AG. That's how I know who's actually here and paying attention. Back to the bigger picture now. The COMEX implied volatility index for silver options is now sitting at 134. When we talked about this in the last video, it had just broken above 100. Now it's at 134, beyond the highs we saw on January 30th, when silver spiked up to $120. This is not a normal reading at all. This is the options market basically saying it expects violent, possibly messy moves that the current price action is nowhere close to reflecting yet. Both the SLV volatility index and silver futures options implied volatility are pointing in the exact same direction. Sharp upside price risk, the price is being held down. The volatility index is screaming. Those two things cannot keep existing together forever. And then there's what happened on the SHFE today. Specifically, the exchange suspended another group of accounts for breaking trading rules. That brings the total number of accounts suspended in February alone all the way up to 23. We watched heavy manipulation attempts at the SHFE open today. Visible, documented, flagged in real time by people tracking the order flow. The exchange responded by suspending the accounts involved. That's not some conspiracy theory. That is the exchange itself confirming the manipulation was real enough to actually do something about. 23 suspensions in a single month. Go verify that yourself. Now the settlement picture, because this is where the pressure is most concentrated right now. March open interest as of Monday sits at 37,651 contracts. That's 188 million ounces of paper silver, heading towards settlement in just 3 trading days. Registered COMEX silver, the metal that is warrant issued and actually available to be physically delivered, sits at 88 million ounces. That's roughly 2 to 1, 2 ounces of paper for every 1 ounce of real deliverable physical silver. The roll is already underway. May open interest has jumped up significantly as people holding long positions have moved out of March, but not fast enough to wipe out the delivery pressure entirely. February 26th is the last safe day to roll March futures positions if you want to avoid physical delivery risk. February 27th is first notice day. From that point forward, shorts can start issuing delivery notices, and any remaining long positions are at risk of being assigned. No debate, the clock is running. What's important to be honest about here, and this is the real straight read, registered silver has stayed essentially flat to slightly down in recent days. No meaningful new metal is flowing into COMEX vaults to refill the registered category. And there's one more signal worth watching really closely. The carry-adjusted basis between March and May futures. Right now the market is watching whether the March to May spread flips from contango into backwardation. In normal markets, futures further out in time trade at a higher price than spot, that's called contango, and it reflects financing and storage costs. When that flips, when nearby silver trades at a higher price than future silver, it's called backwardation. And when a physical commodity market goes into backwardation, it sends one very clear message. It's basically saying, I don't care what the paper price says, I need physical silver right now. We are not confirmed in backwardation yet. But if that flips, it completely changes the conversation. Check the CME data yourself. Jim Rickards in Currency Wars described physical commodity market stress as the moment where financial warfare becomes visible, where the paper system that normally manages how prices are perceived starts to crack under the weight of real-world demand. That's not some theoretical idea right now. That's a description of exactly what's happening in real time between Shanghai sitting at 96 and COMEX sitting at 86. Now zoom out because the geopolitical layer underneath all of this isn't getting any simpler. Crude oil moved up to $67, the highest level since August. Bullish bets on oil are surging up. The question being asked in commodity markets right now is whether people are positioning themselves ahead of a possible Iran escalation. Global oil discoveries have dropped 40% over the past decade from an average of 10 billion barrels per year between 2015 and 2020, down to 6 billion between 2021 and 2025. That is a structural supply problem with a 20-year lag before any new exploration even produces its first drop of oil. When oil moves on both geopolitical risk and structural supply concerns at the same time, it adds an inflationary push into the same macro environment that's already driving gold and silver higher. The import data out of India just confirmed another record month for gold. That's not some isolated data point sitting alone, it's part of a consistent pattern. Eastern physical demand has been running at historically high levels for months now. While Western financial media keeps attributing gold's rise to vague ideas about momentum, mainstream analysts don't really have a framework to explain why spot gold is trading at $5,130. They call it a bubble, they call it speculative excess. What they don't understand is that the capital is flowing because institutions and sovereign buyers in Asia are making a quiet, deliberate judgment about where real value actually lives. Anyone who actually takes the time to verify the World Gold Council data, the Indian import numbers, or the Chinese ETF flow data, understands exactly what's happening. The mainstream narrative is still searching for an explanation that fits their existing view of the world, and they're completely missing the structural shift happening right in front of them. Now the honest case for caution, because balance is what separates actual analysis from just cheerleading. The Shanghai session today showed something really instructive. Silver opened at 99, hit 102, and closed at 96. It did not hold the 100 level. Price discovery was volatile, and ultimately settled lower than where it opened. That tells you there is real selling pressure at these levels. Not just manipulation, but genuine market participants who are willing to take profits or reduce their exposure above 100. The implied volatility reading of 134 cuts both ways too. The same explosive potential that points toward upside can also produce equally violent downside moves if a coordinated intervention, a margin call cascade, or a broader risk-off event forces selling across all asset classes at the same time. And Western spot sitting at 86 while Shanghai closes at 96 doesn't automatically mean Western prices are going to close that gap by moving up. It could just as easily mean Shanghai comes back down toward Western levels if the physical demand signals don't hold up. Humphrey Neal wrote in Tape Reading and Market Tactics that the tape tells you what is happening, not when it finishes happening. The structural story is written in the data. The timeline is written by the market itself, on its own schedule. Here's what the data is actually saying right now. Shanghai closed at 96 with a $10 premium to Western spot, and the final physical lot cleared at 102. COMEX implied volatility is at 134, the highest it's been since the January spike. 188 million ounces of paper silver are heading into settlement in 3 trading days, with only 88 million ounces actually available. No new metal is entering COMEX vaults while the drain keeps going. India is printing record gold imports. The SHFE suspended 23 accounts for manipulation in a single month. The carry-adjusted basis between March and May is getting close to a potential backwardation signal that the informed minority is watching very carefully. And Western price is sitting at 86.40, below a resistance zone. It is now rejected 3 times. The paper price and the physical market are not telling the same story. They have not been telling the same story for weeks now. At some point, that gap has to resolve. Whether it resolves this week, this month, or over a longer time frame, that is the open question. What isn't open is the direction of the structural pressure. Go verify the CME volatility data. Check the COMEX reports. Look at the open interest numbers yourself, and when you do, separate what the data is actually saying from what you want it to say. That distinction right there is where most people lose their money. Not because they looked at the wrong data, but because they looked at the right data through the wrong lens. This is financial warfare education, not advice. Protect your capital, Manage your emotions just as carefully as you manage your positions. The ones who do both, who read the data clearly and stay disciplined when the market gets loud and crazy, those are the ones still standing when the dust settles. Do your own due diligence. Invest with logic, not hype. OG out.